Welcome, everyone. A Forbes article about Faber's book begins with the question, how does an investment manager reconcile all of the various prognostications he hears on a daily basis? His curt and brief response was, ignore them. Over 70 years ago, Ben Graham and David Dodd proposed valuing stocks with earnings smoothed across multiple years. Robert Shiller later popularized this method with his version of the cyclically adjusted price to earning, or the CAPE ratio, in the late 1990s, and correctly issued a timely warning of poor stock returns to follow in the coming years. Our speaker today, Mr. Faber, applies this valuation metric across his global investments. He is a co-founder and CIO of Cambria Investment Management and has authored numerous white papers and 3 books, Shareholder Yield, The IV Portfolio, and Global Value. A frequent speaker and writer on investment strategies who has been featured in the Barron's, the New York Times, and the New Yorker, he is here today to speak about his investing philosophy. So without further ado, friends, let's welcome Mebane Faber.
It's great to be here today. This is a nice, intimate audience, so I usually fly through this pretty quick. So if I'm going too fast, I say something you don't understand, just raise your hand, wave at me. This is interesting because this is probably the first time in my entire life I've been the most dressed up person in the room. Suits for me is normally weddings, funerals. I live down in SoCal, so casual is kind of our normal attire anyway. So it's a bit humorous. Anyway, all right, so we're going to get started real fast. Since I don't see too many familiar faces, quick introduction. Again, my name is Mebane Faber, although I go by Meb. Mebs lately have had a lot of great press. This is Meb, who just won the Boston Marathon. And as one of my friend's moms on social media said when I posted a link to this, said, I didn't even know you ran. I said, well, I don't know if you've seen any photos, but he's in much better shape, much skinnier than I am. I grew up in Colorado before spending some time in North Carolina. I went to college at the University of Virginia. So if anybody is watching the College World Series tonight, go Hoos. We're playing Vanderbilt, so pretty excited about that. May have to make a last-minute trip to Omaha here if we win one of the first 2 games. I actually studied engineering and biology, so I feel like I'm in good company today. Probably a lot of engineers here. My first job out of college was in Washington, D.C. Worked as a biotech analyst for biotech stocks, and was going to grad school at the time before moving to San Francisco. So I lived in the Bay Area for about a year and a half, and then and actually lived with an early Google employee. So I was gravitating more towards the quant side of the business at the time. So moved away from the bench, from the science. I was always really terrible at it anyway, but more towards quantitative investing. A brief stop in Lake Tahoe, where I can get away in most of the country saying that I actually had gainful employment there, but most of you can see through that and say you're probably a ski bum. As you know, there's probably not a lot of high investment companies going on in Tahoe, but an interesting side event story was that when I did live there, I managed to sneak my way into a really, really great Google party. And if any of y'all have been around long enough, this is probably 2004. Anybody here that used to go to the parties they had at Squaw? Wow. Okay, we've got a couple. So, I mean, we're talking 6 stages. This is probably pre-IPO days. You could still get away with this. 6 stages and ice sculptures and fire, and they flew almost everybody in from around the world. And of course, I wasn't working at Google, but had a number of friends did. So, managed to sneak my way in. And I remembered as I was walking in today, I had completely forgotten about this, but they gave every Google employee 2 drink tickets, and then I think you had to buy the rest or something. But the good news is most of my friends worked in travel employment up there, so I had some friends working the hotel front desk, setting up the tents with the guys. And one of the guys says, here, you want some drink tickets? You know, because we're all obviously sneaking into the party. And he said, sure, you know, you only get 1 or 2. He goes, here's 50. Needless to say, I managed to get kicked out of the party later that night, or the after party, but really had a great time there. It was really a lot of fun. moved down to LA. I guess this should be a king's photo now, but been in Manhattan Beach for the past 7 years when I started my company, Cambria Investment Advisor. Spent a lot of time learning how to surf, but I'm pretty terrible. Look like this and this. And if you've seen any videos on YouTube lately, one of the benefits of having technology, of course, the GoPros of the world, is you get amazing footage, right? But also you learn some things you really probably didn't want to know. So being a surfer in Manhattan Beach and all of a sudden realizing that, yes, underwater there's a lot of great white sharks. So you've been seeing a lot of these videos coming out lately where stand-up paddleboarders are just watching these great whites swim through the lineup. I would rather just not know, of course, that our friends are there, but they're harmless, right? A bit about my company. We started in 2006. We manage about 430 million, maybe 440 million now. We do individual accounts. We manage public funds. The goal, and I feel like this is try to include a Silicon Valley term, disrupt traditional high fee investing. I have 100% of my net worth invested in our public funds, so this isn't a theoretical exercise, what we're going to talk about today, but this is what I do with all of my own money. Before we start, this is a fun little quiz we're going to pass around. It's anonymous, so don't worry, nobody's going to see what you wrote down, but ask a simple question is, for those of you who invest in stocks, so ignore bonds, ignore real estate, ignore commodities or whatever else you may trade, currencies, and you have to be a U.S. resident, otherwise they'll bias the data. How much do you put in the U.S.? So let's say you have 80% in the U.S., 20% in Japan, write down 80%. So there's a little piece of paper, it's going to go around, just write down a number, and then when it gets to the end, raise your hand, and we'll get back to this a little bit later. You can find a lot of the information that we write about and publish. Again, I have a blog, mebfaber.com, my company's website, Cambria Funds. There's a third site called The Idea Farm, but all of which we publish. Most of it is free. There's, I think, 1,500 articles I've written on the blog, about a dozen white papers, 3 books. And as a benefit of sitting here during your lunch break or taking the time out today, or if you're watching the webcast, I'm more than happy to send you a free book. You can only pick one though, but the topic of this one today is a book we put out a couple months ago called Global Value. But we've also published 2 others, but I'm more than happy to send you one. Shoot me an email, my personal email address, mebane@gmail. I tried to get meb@gmail in the early days, but they said no 3-letter Gmail addresses when it first came out, sadly. But anyway, shoot me one. Ivy Portfolio is best in harder paperback. It came out at a time when the Kindle software wasn't that great yet, so I would recommend reading that one in a hardcover, or paperback. The other 2, happy to send you a free copy. All right, so we're going to get started on the talk now, and it's interesting because a lot of people, when you talk about investing, it's an interesting science, and it's interesting because so many people have such widely held beliefs, right? And so talking about it in many ways to certain people, especially that aren't as open-minded, it's like talking about politics. It's like talking about religion, right? Trying to convince a buy and hold indexer that you should be tactical is just as difficult as trying to convince a Republican to be a Democrat or someone to switch religions. It's really difficult, but we're going to talk about some interesting stuff today that probably goes against a lot of conventional wisdom. So keep an open mind. You may agree with some of it, may not, but it should be interesting. I was going to name this chart or this topic, "You Suck at Investing." And when I say this, I don't mean any of you specifically. I'm not pointing out any one of you, although most of you do, but you're terrible at investing. This is the broad investing public. This is an example of a study that comes out by Dalbar that shows investor returns, dollar-weighted returns. And as you can see, typically, everything did good except for the average investor. Morningstar replicates this study for funds, right? So the average investment fund, when the money comes in, when the money comes out. And typically what happens, people are emotional. They have a behavioral bias where they rush into stocks or performance of a fund at the top and then sell at the bottom, and they do it over and over and over again. That costs you roughly about 2% a year, typically, right? So all of you that are getting really excited about stocks again, after the 5th year of this bull market, but weren't investing in 2008 or 2009, you maybe want to take a little bit of pause, think about it, but it's important to come up with a systematic investment approach to avoid some of these genetic behavioral biases we have. A good visual representation of this is there's a American Association of Individual Investors polls their readers and says, simple question, are you bullish on the stock market, bearish or neutral? This goes back to the late 80s. And so the red X is kind of the average values. The green triangle is where we are now. So kind of average. What you can see though is a little bit of complacency. The neutral is a little higher than normal, right? And that kind of reflects what's going on in the market. This low volatility, a lot of people haven't really participated. They got out in 08, 09 and have never really gotten back in, don't really know what to do. But what you do see, when were people most bullish? The absolute worst time in history to be bullish, January of 2000. For those of you that were investing then. When were people most bearish? The absolute best time to be investing in my career, March 2009. This goes to show the whole point is that your emotions can work against you, right? And it's what has come down in our genetics for many millions of years, right? What was important when you're on the savannah and a tiger is chasing you is very different than what the skill set and genetics needed to trade shares of IBM or Google or short gold or whatever it may be, right? So, but this isn't anything new. This is something that's been going on for hundreds of years. This is an example that goes back to the early 18th century. This is in a paper we wrote called Learning to Love Investment Bubbles, but this is an example of one of the most famous bubbles, and there's some great books on this topic. Extraordinary Popular Delusions and the Madness of Crowds is a really wonderful one, talks about many historical bubbles. What this shows is an example of a stock that went parabolic in the early 18th century. It was a South Sea stock. We talk about it in this paper. It's a really interesting story. It involves a lot of the things that typically happen in bubbles: easy access to money, credit, people borrowing. But the most important one is people making a lot of money. And a very great example is one of the most rational, brilliant scientists of all time, Sir Isaac Newton, was an investor in this company. It goes to show his experience that will probably mimic a lot of investors' experiences in stocks that went parabolic and went in bubbles. So an example, I joke a lot on my blog and Twitter that this probably looks like a chart of Bitcoin, to which I get a lot of hate mail about, strangely. I've been writing for 7 years and all of a sudden I start getting hate mail. Anyway, so this example, so Newton buys in, doubles his money. What is that? Yeah, doubles his money. Could not be happier. What's the worst possible thing when you've made money and gotten out? Well, it's that your friends are making more money, right? Someone just sold an app company. Uber's valued at 18 billion. Someone else did this Yo app that's getting millions of downloads, right? What's the worst possible thing that happened? Is your friend in the next cubicle is making more money than you, or your friends are all getting rich, but you're not. So what happens, of course? Well, then he decides to buy back in, okay? Well, of course, he's buying near the top, at the peak. What happens? It crashes 90%. Well, then he sells at the bottom. Okay, well, this is something that happens over and over again in investing, and so I just want to show it's nothing new, and think about this as we go forward. So, what can you do? Is there anything you can do to remove this emotional decision making, right? To combat our behavioral biases. Well, so there's these two good-looking guys. You may recognize, may not. On the left is Ben Graham, often known as the father of security analysis. He wrote a couple great books. He's a professor in the early 20th century called Security Analysis and Intelligent Investor, right? And what he proposed is when looking at an investment to value the company, and often to smooth out the valuation by using earnings over a number of years. Not just looking at 1 year of earnings, but his preferred metric was smoothing it out over 5 to 7 years as a way to smooth out the business cycle, right? As a way to have a fundamental anchor to be able to compare companies to each other on a long-term basis. Fast forward 80 years later, so this is nothing new, this has been around almost a century. Robert Shiller, recent Nobel laureate, just won with Eugene Fama, professor at Yale. He put out a white paper in the late 90s called Irrational Exuberance, a white paper, then a book called Irrational Exuberance. Alan Greenspan later used the term in Congress, promptly sent the stock market down quite a bit. But he says, let's take a look at this, but let's use it on the market-wide basis as a whole. Let's look at 10-year average earnings across the entire U.S. stock market. Call it the 10-year cyclically adjusted price earnings ratio, CAPE, right? So this is an example of what that looks like back to 1881. So that's a long time. And the problem you have with efficient market people would say the market's efficient, you can't predict bubbles. Or sorry, bubbles don't exist. First of all, they say bubbles don't exist. If they do exist, you can't predict them. And that doesn't make much sense to me. If you look at this chart, there's an average value of around 16, 17 times earnings, right, that the US stock market has been in. There's times when it's been incredibly low, in the low single digits. Think 19 teens, as well as post-depression, but there's also times when things get incredibly bubbly. If you look at the late 20s, you got to a value of over 30. If you look at the biggest bubble in the US stock market has ever seen, the late 90s, you get a value of 45. Does it seem even remotely reasonable that it is a good a time to buy stocks when they're trading at 45 times earnings in 1999 as it was in the early 1980s at a value of 5? That does not pass a common sense sniff test for me. So if you look at this, you say, okay, does it work historically? You know, being a scientist, an engineer, does this work? Historically, it's worked great. If you buy stock market when it's cheap, at say less than a CAPE ratio of 10, you get great future returns. These are 10-year returns going forward, real returns, so we're netting out inflation. And it's a nice stair step down. The more you pay for stocks, the lower your future returns are. It is, again, it's not rocket science, it's simple, but this works out over a long-term time horizon. If you look at where we are now, we're at a value of around 26. So unfortunately, in the worst bucket, where the red line is right now, where future returns should be pretty muted, pretty low. We don't think it's a bubble, you know, it's not crazy, but I was talking about this at lunch today. There's a spectrum of future returns, right? And simply the more the market goes up in the meantime means the lower your future returns are going to be. The more the market goes down in the meantime, the higher your future return is going to be in general. The best possible thing that could happen if you're a young person in this room is the market to crash by 50%. Maybe not the best possible thing, but the best possible thing for your investing career, because you can then invest in the US for the next 10, 20, 30, 40 years at a much cheaper valuation. That is not the opportunity set right now, unfortunately. We're going to stop on this one real quick. It's just a scatter plot for the nerds out there like me that goes to show that valuation, it looks almost like a shotgun blast, right? It doesn't explain everything. We're in kind of the yellow area, but in general, the more expensive you pay for stocks, the worse the future returns are. The less you pay for them, the better the future returns are. I don't expect you to see this chart. I don't expect you to really even appreciate what it is. From just the colors, it looks like a bowl of like Fruity Pebbles, right? But what this is CAPE ratio buckets. So the dark green are the cheapest buckets, all the way out to red, which are the most expensive. And these 5 columns are future annualized 10-year returns. And the only takeaway from what you should see in this chart is that most of the green stuff is on the right, meaning your starting points, when they're cheap, great future returns, and most of the red stuff is on the left. When you pay too much, in general, you get crappy returns going forward. However, it's not guaranteed, right? You see there's 3 great returning years on the far right when you started out with pretty rich valuations. And on the left, there's even a few green, light greens, when markets were cheap that you had kind of low returns. So valuation is not, it is what we like to call a blunt tool. It is not an exact science, which makes it challenging as well as fun. But if you look at the 10 best times to buy stocks in the past, I think this is 114 years, awesome returns, 16% a year, net of inflation. You can really compound massively at that level. The starting valuation was around 11. The 10 worst possible times to be buying stocks over the past 114 years, negative returns every year. Starting valuation was an average of 23. All right, so where do we find ourselves today? A secular bull market starting point around 11, or a secular bear market starting point around 23. The bad news is we're on the more expensive side. There's a caveat, of course. This is the PE ratios versus inflation. When inflation is low and contained, let's call this 1 to 4% safe range, which goes from about here to here, people were willing to pay more for stocks, right? Because the future is slightly more certain. When inflation is really high, think about Argentina, think about these countries that have consistent high inflation, Venezuela, and you're a business and you're trying to plan for the future, it's really difficult. On top of that, your future cash flows are worth less because every month you're losing money to this erosion of inflation. So you'll see a warning sign. This may never happen in the next 10, 20 years, who knows, maybe it will. In the 70s, the US had double-digit inflation. It's hard for many of us to comprehend now, but thinking about inflation going up that much, when we live in a world of, let's call it 1.5%, 2% inflation, hopefully right now, not even that much. But the takeaway is that until inflation gets above really that 3-4% kind of upper level, people are willing to pay more for stocks for that certainty. Again, they're not willing to pay 26, which is off this chart, but they're willing to pay a little bit more. There's a lot of criticisms of this valuation methodology. What I want to impress on you, when you're valuing something, most of the valuation indicators should agree. So it doesn't even really matter if you're using CAPE or you're using price to book or you're using cash flows or Buffett's favorite market cap to GDP. In general, they should say the same thing. But so a lot of people say the measurement period's too long. In our book, Global Value, we show that the best period is around 5 to 7 years. So actually, Ben Graham was right. 7 years, I think, was the best. 10 is just fine. What's the worst? 1 year earnings. What do most analysts on Wall Street use? 1 year earnings. We don't know why. A lot of people say that it ignores depressions or bubbles. We're not going to get into that because we don't have enough time today, and we certainly aren't going to get into the accounting. I'm talking about reported and operating earnings, but if you want to email me or you have questions, more than happy to talk about it. This is a good chart from my good friend John Hussman that goes to show it doesn't even matter what valuation metric you use. These are a bunch of different models using earnings, dividends, Shiller CAPE. This is Buffett's favorite 10-year market cap GDP. And then how does it actually work? The future 10-year returns. And what you can see in general is they all tend to move together, right? Generally. You know, they're not going to be incredibly specific, but what this shows is this is projected future returns, right? So it's like the valuation chart flipped upside down. What it goes to show, and it's pretty good at this, it says, look, when returns projected to be the worst, late 90s, right? That's a terrible time to be buying stocks. But as the market has gone down, stocks have gotten better. And in 2008, stocks were supposed to return double digits, but no one wanted to be buying, even though they were cheap. But certainly not a good buying opportunity as the early 80s, which was the start of the biggest bull market we've ever seen in the US. But getting better. So again, people like to think in terms of stocks are expensive, they're going to crash, sell, or stocks are cheap, we've got to buy them, they're going to go up to double digits. But in reality, it's usually somewhere in the middle. People don't like hearing something like the future expected returns are going to be about 4%, which is what we think, which is what the model shows, which isn't that exciting. So as you think about this, you know, and thinking about bubbles and thinking about the efficient market and not overpaying for something, you know, we think it's important to understand risk, right? And the risk of loss and the very real risk of losing a lot of money. Great Arthur Ashe quote, either you understand the risk or you don't play the game. You know, and we have a picture of the mouse who's trying to get the cheese but being smart about it, wear a helmet. And somebody on Twitter the other day said, you know, it's kind of, Meb, your CAPE measure, or the Shiller CAPE measure is kind of like, you know, the difference of chance of fatality if you're driving a car at 200 miles an hour versus 5 miles an hour, right? You're much more likely to get into a big wreck, fatality at 200 miles an hour than you are at 5. So that leaves us with the problem. Every pension fund in the country expects 8% returns per year. We wrote a paper called What If 8% is 0%, right? Pension funds investing with eyes closed, fingers crossed. What do? US bonds yield 2.5%. Stocks should return around 5%. That's not that exciting, right? Your 4% yield or 4% roughly return, the math doesn't work out. It doesn't work out for a lot of institutions. They're going to have really big troubles with their pension funds that will likely eventually go broke in the next 10 to 20, 30 years. So what do? If you're looking at returns, what do? This is a chart. We'd never seen anyone do this, so we had to go create this. We said, all right, we live in a global world. Let's look at 45 developed and emerging economies, countries, and come up with a CAPE ratio for all of these, right? And so we took this back to the early 80s. And in general, the takeaway of this chart is that most things move together, right? And generally, stocks are correlated. It's a globalized world, right? What happens in the US is going to affect what happens in China and India and Japan, and vice versa. So in general, they move together. However, you can see some pretty wide dispersion at certain times and over the years. And then you also see a few things. This massive, massive outlier over here, this bubble. There's a lot of young faces in the crowd, so you probably don't remember this, but Japan in the late 80s was widely expected to take over the world, right? Their companies were better, the cars were better, they're more efficient companies. The valuation of their stock market is the biggest bubble we've ever seen, and it's not even close. They hit a valuation ratio, CAPE of like 95, or maybe it's 99. I can't see, 95 it looks like. And so it's funny because you'll hear commentators talk about the lost decades in Japan and how terrible the stock market returns have been in the 90s and 2000s, right? No, it's because they had one of the biggest bubbles you've ever seen, and it's taken them that long to work that off, right? When did Japan finally get back to a reasonable valuation? Only in the last few years. What happened? Japan is the best performing stock market in the world last year. So, but the efficient market person will say that it was just as good a time to buy Japan in late 1989 when the real estate under the Imperial Palace was worth more than the entire state of the real estate of California, right? Things that just don't make sense. But to us, coming up with this objective measure of a fundamental metric, fundamental anchor, can that help you? So we said we reran the same test. Does starting valuation impact future returns? The answer is it does. In the same exact way that the US did, right? The less you pay for something, the better it is. I don't care if it's baseball cards, a Tesla, whatever you think, the less you pay for it, the better it's going to be. The more you pay for it, the worse the returns are going to be. Where are we right now? And with foreign developed markets and foreign emerging, they were both right around 15. So the two red bars here, emerging was a little bit cheaper. So this bar, developed, is a little higher than 15. But much better returns in the far right bucket, which is the US, right? So much more opportunity. What happens if you went back and said, you know what, we're going to only invest in the cheapest countries? Instead of this global portfolio, what if we just invested in the cheapest 25% of countries each year? Takes 5 minutes a year, rebalance. Well, that would have done fantastic. So this is what the global portfolio would have looked like. The top cape, which is the cheapest countries, did much better job than the bottom cape, the expensive countries, okay? Again, not complicated, but buying value works, has worked over time. Enormous amount of literature that shows this investing in stocks works great. And this is what the equity curve looks like, right? This is a logarithmic chart to equalize returns over time. But again, yellow line, that's investing in what's expensive, not a bright idea. Black line, buy and hold of all the countries. And the blue and red lines are two different variations of buying the cheapest. One is, you said, you know what? It probably makes sense to invest in the cheapest, but only invest in the cheapest when they are the cheapest. What if everything is expensive? So like the late 90s, for example, right? You don't want to be investing in stocks when everything is expensive. So we use an absolute metric cap of around, I think it was 18 in the book, maybe it's 20, to say, you know what, if things get that much, we'll start to move to cash, right? And so you go come up with a little bit less volatile portfolio, same returns over time, but avoid some of the big drawdowns and losses of buy and hold. But what's really interesting, and this happens a lot in various fields, is I have a buddy, John Bollinger, says, you know, all the information is in the tails, right? So the ends of the distribution. That's when things get really interesting. And so what we call is, there's a famous investing phrase that says, investing when there's blood on the streets. Hopefully not literally, but when things are really, really bad. So we call this at a CAPE ratio below 7, which doesn't happen that much. It's only happened in the US a couple times. Future returns are fantastic. 1, 3, 5 years, you're compounding your money at 20% a year. And what's the opposite? Bubble, right? Where the markets are really expensive, over 45. So that's the peak of the US, right? But anyone remembers back to 2006, 2007, if you were investing then, the BRICS, right? This expression, Brazil, Russia, India, and China, right? That's where you want to invest. That's where the world's going. What they didn't mention was that China and India were both trading at capes above 40. I think China hit 65, right? And so China's had horrific stock market returns since then. Is anyone talking about China that much anymore? No. But China's at a great valuation now. But this is what happens over and over. People are much more interested in investing here. They're excited because returns have been great than there. It's really hard to invest in the low markets. Part of that is simply behavioral, right? All the news is bad, right? The news is usually terrible. So let's give you some common examples. Where are we now? I just updated this at the end of last month. If you look at the left, the cheapest markets in the world, Greece hit the lowest valuation we've ever seen at a value of 2 in the summer of 2012. Greece is now up 200%, their stock market off the bottom. Russia hit a value around 5, may got down to 4 a couple months ago. Ireland, Hungary, Austria, Italy, most of Europe, right? But where the returns are best is when things go from truly horrific to merely less bad. Russia is a perfect example. We've been on TV the last few months pounding the table for Russia saying, Russia is cheap on every valuation metric we can find. To which all the TV anchors say, well, what about Crimea? What about Putin? What about all these things that are happening? So but that's when you want to be investing. Sir John Templeton, famous quote, he says, don't ask me where things are best. That's the wrong question. Ask me where things are the worst. The challenge with why this strategy works and will continue to work, imagine going home to your wife, your husband, sister, brother, neighbor, and say, you know what, I heard this great presentation today. I'm putting my money into Greece and in Russia. Now, the next you'll get slapped or divorced or whatnot. In my industry, you'll get fired, right, as a money manager. And it's funny because the European names, don't elicit as much hatred right now, right? Most people say Hungary, Austria, Italy, okay, interesting. You go back a couple years when the euro was disintegrating, no one wanted to be investing in those countries. Italy, second best stock market in the world this year. It's up, I think, almost 20%. So when things, as the news flow recedes, Russia, from the bottom, here's the dumb things you hear at the bottom, right? U.S. government press secretary goes to Twitter and says, someone asks him about Russia, and he says, you know what? I would be selling Russian stocks if I were you. In fact, I would be shorting them. This is the press secretary giving this advice to the general public of not only selling Russian stocks, but shorting them, okay? He's suggesting, first of all, telling the investing public to short anything, horrific advice. You can lose your entire account. Talking about shorting a market that goes up and down 5% a day, the volatility is off the charts. And oh, by the way, is the second cheapest market in the world. What's happened since then? I like to, not patting myself on the back. Russia's up, 25% from the bottom? Press secretary no longer has a job. I'm not saying that's why, related. But if you look at the right side, these are the most expensive. I was really unpopular in the last year. I gave talks in Colombia, in Bogota, and then Mexico, and I said, look, I love your country, I love the food, I love the people, but your stock market's one of the most expensive in the world. And Colombia at the time was in the mid to high 30s, and their market has got pounded since then. Again, I'm only going to start traveling to countries where they're really cheap now, so they'll enjoy my message, say that's great, bring us good news. The U.S. is one of the most expensive in the world, okay? The U.S. is not in a bubble. It's nowhere close, but returns maybe 5% a year going forward. But what's important is even if you invest in the indexes, right, the broad foreign developed, there's huge dispersion within those indexes, right? So what we talk about is buying a basket of these countries. And here's why you need to buy a basket instead of just one. This is Greece stock market, and then the black numbers are the CAPE ratios over time. Late 90s, reasonable CAPE ratio, awesome return, market doubled, 150% returns, hits a value of 40, that's bubble territory. Massive bear market around with the rest of the world, 2000, 2001, 2002. Hits a low single-digit value, great time to be buying. Massive run up again. Hits a value where the U.S. is right now, not terrible, but then the Euro crisis, 2008 happens. And the challenge here is that this is what they call catching a falling knife, right? Where the market's falling, it's getting cheaper and cheaper, but then it proceeds to get cheaper still, right? Once this got to 10, you would say that's cheap. And then you bought it, and then it goes to 8, then it goes to 6, then it goes to 4, then it goes to 2, right? So you watched it continue to get cheaper. There's a famous investing joke that says, what do you call a market that's down 90%? That's a market that was down 80%, then proceeded to go down 50% more, right? The way the math works out. And then we talked about this at lunch, the compounding that people talk about, eighth wonder of the world is compounding, right? Where if you just invest long enough that it works out in your favor. Well, what they don't talk about is the opposite. The bigger hole you get in, the compounding works against you. So the kink doesn't really happen until you lose about 10 to 15% of your money. You lose 10%, it takes 11 to get back to even. You lose 20, it takes 25. You lose 50, it takes 100% to get back to even. You lose 75%, it takes 300% to get back to even. You think 75% is unrealistic? U.S. had a 90% drawdown in the 30s. U.S. has had multiple 50% drawdowns. Every G10 country in the world has lost at least 2/3 of its stock market value at one point. So go ask someone in Cyprus what they think about buy and hold investing. You'll get a very different perspective than someone in the U.S. We've been publishing these values for a while. This is just a good example of 2013. and where the values stood at the time. I don't expect you all to see this, but again, Colombia was up at 34, Peru at 34, Greece, Ireland. I don't include the frontier markets usually, but we used Argentina because they're too small and illiquid, but a lot of those names. And then what happened? Well, had you bought a basket of the bottom 5 countries or 10, 20% returns in 2013. If you bought the most expensive, -5 to -18%, right? So buying expensive stuff, not a great idea. There's 2 outliers here. One, cheap country, Russia, which went from 7 down to 5, had negative returns last year. And what's the outlier on the opposite side? Expensive country that got more expensive. The US had a monster year last year. There's nothing that can stop. So this is one of the challenges of being an investor with a long-term time horizon. You have to mentally prepare yourself for the possibility, however small it may be, that the US market can decline 80% or increase in value 100%, right? Those valuations have existed in the past. So from where we are today, what's the only difference? What people are willing to pay, right? That's it. How much are you willing to pay for one share of the S&P 500? And so both of those happened in the past. And most people set up their investing program or how they invest ignoring both of those possibilities. So you know what, if I just have a long enough time horizon, things are going to be okay. Can you sit through a 50% bear market? Can you sit through an 80%? Going back to the statistics earlier, remember, people can't. They buy things when they buy things here, they sell things there, over and over again. The good news, I don't want this to be too depressing, this is the average of global valuations. Generational lows, single-digit CAPE ratios, early 80s, again, best time to buy in everyone's career, but expensive, things got expensive, late 90s, a special bubble, market got hammered, went back up, '07, right, bubble territory again, huge bear market. Most of the world has lagged the US over the past 5 years, so we're down in this cheap territory. Most of the world's pretty cheap, and going back to this chart, many countries are really cheap, all right? So moving towards the left side of this chart, away from the right side of the chart, is important. Why this matters to you? Where's that piece of paper? Did you pass it up to me? Oh, geez, you guys are even worse than normal. Okay. There's another bias called overconfidence, and I'm sure this room has it in spades. This is why I became a quant. Is I read a lot of literature. I suggest behavioral. There's a lot of great behavioral books. James Montier writes some of the best there are. But to take a little time and read those books, because you'll see a lot of behavioral biases. Overconfidence, right? More than half this room thinks they're smarter than the other half, better looking, better drivers, right? Statistically, that's impossible. And same thing with the population. I asked this question, I've asked it in my last 8 speeches. I've gotten the same answer more or less at every speech. The average amount people invest, and I'm sure you circled it here, this is it, right? 78% in the US. That's called home country bias. It happens in every country around the world. Americans invest all their money in the US. Italians invest all their money in Italian stocks. People in Greece do the same thing, people in Japan. That's a terrible idea, and I'll tell you why. It can be a good year, but it can be a good idea. In general, it's a terrible idea. The US, this is global market capitalization. What percentage of all these countries are they of the entire world? US is half. If you were a Vanguard, John Bogle devotee, indexer through and through, buy and hold, you should only have half your portfolio in US stocks. No one does. You go to a financial advisor, any advisor almost on the planet, and say, what do you think, how much I put in the US? It's almost always 70%, which is the broad average for the country. Not just retail, but professional as well. Same thing happens in every other country, right? And it's more insidious in other countries because often they're a tiny part of market cap. So Canada, you're 4%, but you're putting 70% in Canada. You're getting no exposure to the global world. Think back to the Japan example and why this is so bad. And this lines up the 2 bubbles just to show you how bad the Japanese just dwarfed our cute 90s internet bubble, right? This is kind of months to the peak, so we just lined them up. But this goes to show this massive bubble. Look how long it took Japan to work that off, right? It only got cheap in the 2010, 2011, 2012. Japan in the late 80s was half of world market cap, same as we are today, right? That's hard to think. Those negative returns for the next 20 years were a massive drag on your portfolio, right? On a global portfolio, which is what market cap weighting does. Market cap weighting means you're investing based on the broad portfolio. You invest the most in the biggest companies. Right now, that's what Exxon, Apple, certainly up there. But usually, the only metric they're using is price. They're not using valuation. They're just what's biggest. Well, That's a terrible thing. This is a chart of the S&P 500, is the blue line. This asks a simple question: what if you invested in the biggest stock, biggest company in the U.S. when each one held the crown? So familiar names: Apple, Cisco, Exxon, GE, IBM, Microsoft, Walmart. It's a horrific thing to do. Look at how much worse the returns are. Let's think about why. It's simple capitalism, okay? When you're big, when you're Google, you have a huge target on your back. Why? Well, everyone else would like to make money too, right? And they see how successful you are. So it's simple competition. There's a study that came out from some friends down in so-called research affiliates that said, what happens if you invested in the largest company in the market? One of your future speakers actually did a study on this as well, Monish Pabrai. He'll be talking here, I think, next month. Said, what happens if you invest in the largest company in the market? That company underperforms the market by 3% a year for the next 10 years, all right? Big time outperformance. Happens in every sector. The largest stock in every sector underperforms the market in the next 10 years by 3% a year. So and the reason being, again, going back to Japan, market cap weighting overweights expensive countries and companies, all right? So because the reason they're expensive, there's only one variable, which is size. Typically, the biggest is most expensive. It's not always the case. Right now, for example, small caps, I would not touch them with a 10-foot pole in the US. They're the most expensive they've ever been relative to large cap stocks. So I would highly avoid. But again, the US isn't always one of the most expensive. This shows us right now, black line is US, red line's average CAPE valuations, yellow is cheapest and blue is most expensive. So there was times when the US is one of the cheapest countries, right? In the early 80s, best time to be buying. And there's times when it's been relatively cheap to the rest of the world. You could kind of use this as a guide to saying, are we cheap relative to the world, or are we not? And right now, we're one of the most expensive. So not a great time to be getting away from the US. Some other questions. I think I'm going to zoom through the next 5 minutes. Does this work with sectors in the US? It does. Robert Shiller has published extensively on this. Does it make sense to add some other things like trend? We talked at lunch about my favorite intersection is value and trend. So when something is cheap but starting to go up, right? Italy is a great example now. Brazil, maybe, turning the corner here. But we're going to shift gear real quick. Talk about something, because this is a engineer-focused crowd, because you have appreciation for data. This is an interesting topic, and probably an area for study for those of you who are thus interested in stocks. You know, going back to what we were talking about earlier, most people stink at stock picking. They're horrific at it. They're really, really bad for a lot of the emotional reasons. But it's a tough game you're playing, because you're up against the smartest investors in the world. Some of these hedge funds that have staff of 50 people that are out there paying them the top money in the world, that's who you're competing against. It's not the guys on the internet chat rooms, right? But the math of it is difficult. There's a paper called The Capitalism Distribution, published by some friends of mine, that showed just how difficult it is. The average stock, it's 2/3 of stocks. If you just picked it out of a hat, 2/3 of stocks underperform the index, right? Because when you own an index, you are guaranteed to own the winners. The losers simply go down to value and they go out of business. So you're one of the reasons why stock investing works is you're just investing in capitalism. You're investing in business, right? But 2/3, if you're just picking out of a hat, if you go pick a company out of the Wall Street Journal, chances are you're going to underperform the index. So the math is already working against you. Half of stocks are losers over their lifetime, right? But it's the tails, right? Going back to earlier, it's the tails that matter. It's the few Googles, Apples, Walmarts of the world that account for the vast majority of your gains. So a question I asked when I was in college, I said, I meet all these hedge fund managers, these interesting guys that, I said, why wouldn't I just outsource this to Warren Buffett? He's clearly much better at this than I am. He's been managing money forever, incredibly successfully, one of the richest people in the world. Why wouldn't I just outsource my stock picking to him? And what most people don't know is that you can. The SEC requires that any institution over $100 million has to publish their holdings. It's every quarter. There's a 45-day delay, but they are available online, all right? So I said, why wouldn't I just invest in what Buffett buys? And being an engineer, being a quant, this is late 90s, I said, I can't do this until I work with the data. And what we found largely is you can. If you bought Buffett's top 10 stock picks, updated every quarter when the values are public, and there's now an academic paper that validates this, you would have beaten the market by, well, this goes back to 99, 7% a year. That is a monster number. That would outperform every possible mutual fund out there. The paper takes it back to the 70s, finds similar outperformance. This is a local company I helped co-found many years ago called AlphaClone. that does a lot of the analytics with these hedge funds. Now, it's important when you're focusing on these funds, this requires a little bit of domain expertise to at least kind of know what some of these funds do. You want funds that are stock pickers, that are not shorting, that don't have too much turnover, they're not active traders, they're not doing anything weird like arbitrage, they're not doing futures or derivatives. But in general, stock pickers, long-term time horizon, this works great. You have a lot of benefits. You can control the holdings yourself, there's no fraud, you don't have to lock up your money, and the biggest one, there's no 2 and 20 fees. There's a number of examples where these, what we call clone portfolios, just by investing in what's available online. You can go to SEC, there's a lot of websites that track this, Guru Investor, Insider Monkey. These underlying clones will end up beating the manager because the manager's charging 2% management fee, 20% performance, so you actually can do better than they can. Why any institution in the world doesn't do this rather than investing in the managers, I don't know. We have my 4th book will probably be on this topic coming out in the next few months, so stay tuned. But another one of my favorites to watch, Seth Klarman at Baupost. Anytime you could watch him, beats the market, what is that, 9-10% a year. And one of the nice things is that the views are often truly variant. You know, some of these names they're picking, even if you don't follow them blindly, but use them as what we call an idea farm. So a place to go look for new ideas for stocks. This is much better than going and asking your broker for ideas or your next door neighbor. Appaloosa, another one of our favorites, has absolutely just destroyed the market. You know, by 18% a year. David Tepper, that's one of the reasons he now owns part of the Steelers. And then of course a local shop, Value Act, was in the Wall Street Journal last weekend, beats the market by 14% a year, and it's something like 6 of the last 7 years. So these are all great places to look for research. One last slide, and then I'm going to wind this down. We talked about this at lunch a little bit, and this is one of the biggest challenges of investing, is that, and going back to the religion and thinking about politics, is that people often have their approach, right? How many investors you know say, you know what, I'm investing for income. I'm a dividend person. This is how so many retirees say, I'm buying high dividend stocks because I get these checks I can cash, right? Dividend payments. Can't fake that, can't fraud that. Well, dividend stocks, what this shows is the blue line is dividend, high yield, if you bought a basket of high yielding dividend stocks, and it goes back to the 60s, the reason investing in dividend stocks historically works is because you're buying value companies. They're cheaper than the overall market. There's reasons often because they're more leveraged and they're usually in a little more trouble, but in general, they're cheap stocks, right? So historically, high dividend stocks have traded about a 30% discount to the overall market. So by buying dividend stocks, you're getting value, right? But it changes over time. This is what people call waiting for the fat pitch in baseball, right? Not swinging it when things are balls, but right down the middle. Well, what happened? Dividend stocks were the cheapest they've ever been in the late 90s relative to the overall market. Why? Well, everyone wanted pets.com. They wanted all these internet companies, these huge market cap Cisco's of the world. They got incredibly expensive, right? So that was the best possible time to be buying dividend stocks. No one's talking about dividend stocks in the late 90s. Massive returns. Dividend stocks didn't even have a 2000, 2003 bear market. Sailed right through it. But what happens when you're in an environment where bonds yield 2.5%, US stocks are going to do maybe 4%. People are looking for yield. Massive amounts of money flows into these high yielding stocks. What does that do? Well, it totally changes their composition. High yielding dividend stocks now, for the first time in history, traded a premium to the overall market. They're more expensive than the overall market. You don't have to believe me. You can go to Morningstar, type in your favorite dividend fund, look at all the valuation metrics, and they're more expensive buying the overall market. So there's an entire group of people that will be buying these stocks for the last few years and wondering why in the world their portfolio is underperforming the market so much. And it's because they're buying something expensive, which is an example of investor behavior totally distorting something that historically has worked great. A new fad is low volatility investing. People investing in low volatile stocks historically have beaten the market. What's happened? Massive amount of money has gone into those. Those are also more expensive now. If I had to do anything, I would avoid high dividend stocks, small cap stocks as well. So I'm going to wind this down. Again, this wasn't theoretical. We manage public funds. I have 100% of my net worth invested in Global Value, is the one that goes and buys these 10 countries. But we'll be launching lots of new ideas as well. So if you have some good ideas, please let me know afterwards. Here's my contact information, phone number, work. It's not my cell phone. Blog, email address. Feel free to email me for a book. And I think we got time. I'm opening it up for questions now.
Oh, hi. So it seems to me that the global CAPE ratio is kind of correlated over time. So as a strategy, should you buy low CAPE ratio countries and also short sell high CAPE ratio
Great question.
countries?
The question is, if you didn't hear it, if it's a good idea to buy the cheapest, why not also short what's most expensive? It's really hard to do. If that is what's essentially called a long, short, or market neutral strategy, right? Where you want to essentially arbitrage the expensive stuff and the cheap stuff. The problem is, over time that works. It works great, but there's almost always large drawdowns, large losses in the meantime. And let me give you examples why. 2008, if you were doing a market neutral approach, the expensive stocks just get hammered all the way down, right? But what happens at the bottom, when the rally comes, what rallies the most? It's the junk, right? It's the junky companies that are now trading at $1.80 or $4, and all of a sudden you're short those, and then you lose 80% on the upside, even though your longs only did 30%. So it's really, really hard. There's some things you can do, and this is getting a little more complicated, such as if you're shorting, you short less the more the market goes down. So you take chips off the table. So you're saying it doesn't make sense to be shorting something if it's already down 50%. It can't go that much farther. Country's not going to go to zero for the most part, right? So you could have a short exposure like right now, but as those countries go down, reduce the short exposure over time. But it's tough to do. And again, so two other caveats to what we talked about today. One, you only need to update this about once a year. A deep value approach needs time to work. The more you update it, the worse it's going to do, all right? And two, in going along the lines of what you're saying, what's important about the strategy is not just that you're buying the cheapest, you're also avoiding the most expensive. So avoidance, I think, is just fine. Shorting, unlike the press secretary, I wouldn't recommend it. Okay, the question is, U.S. has exposure to a globalized world, right? Roughly what, half of the U.S. revenues come from abroad? But vice versa. As the world gets more globalized, much of the countries abroad, China, Mexico, Canada, all have exposure to the US too, right? So our opinion is that we just assume correlations of one, very high correlation of stock markets, right? So in that world, it comes to a more simple question, is not to where the revenues come from, but where is it just cheapest? So where you're getting foreign exposure, so you can get foreign exposure in the US at half, or you can get foreign exposure elsewhere for much cheaper. So it's more important to us in a globalized world just to buy what's cheapest. If the opportunity set is similar and they're highly correlated, which they are, I mean, it's not one, but global stocks in general are up around 70, 80%. That's great because then the valuation means even more.
When you're looking at returns of global stocks, are you taking into account currency fluctuations?
Oh, I knew that question. That question always comes up. Good question. Question is, what about currencies? And this is quite a simple sounding question, but a much longer answer. When you're thinking about currencies, there's a quote that says, currencies understanding currencies aren't difficult, they're just confusing. And Americans are the worst at it, right? Most people, when they think of currencies, they think of, all right, the peso is going down, and it's now cheaper to go buy steaks in Argentina, or maybe it's getting expensive to go skiing in Europe, and that's it. They don't think about them in terms of investing. They do have a very real impact. Over time, currency real returns, because currencies adjust for inflation, over time, currency real returns are stable. Keyword being over time. In any given year, you could have a currency like Japan last year move 20, 30%, which is a lot. So I'm actually, if you have no value-added way to predict currencies, which I would argue most don't, I would argue you have to choose one side or the other. You're either agnostic and you say, you know what, I'm going to do it from US dollar based, or you hedge all your currency exposure. But you pick one and stick with it. And over time, they'll have the same performance. And then a follow-up is, can you do things in currencies the same way you do in stocks and bonds that have outsized returns? So yes, you can actually index currencies with basic value, trend, momentum, carry strategies that perform great and don't correlate to stocks. But that's a point of a whole nother 2-hour talk. So you guys have me back in 2015. We'll talk about currencies. So I'm agnostic, but it makes a big difference in the short term.
in terms of the current valuation, it seems to me that Warren Buffett, Joe Greenblatt, and also Howard Marks, both, I think all of them said that it's reasonable right now. And the only one I know that is kind of bearish in the long term is like is Klarman, right? Yeah. So like, can you reconcile with them? Because like, if Warren Buffett and Joe Greenblatt both said that it's reasonable, then it's hard for me to think that it's expensive, you know.
Well, if you use Buffett's own favorite valuation metric, which is market cap to GNP, stocks are very expensive. You also always have to ask why people have the opinion they do. If you're a money manager and have all your money invested long stocks in the U.S., are you going to say they're expensive? Probably not. So it's challenging, you know. And going back to the intro of the speech, I think you should ignore all of them, right? Everyone's going to have an opinion, just like, you know, a guy or girl walks by, 10 people are going to have different opinions. Say, well, you know, that I like him, I don't like him, he's attractive, he's not, whatever it may be. But that's what makes a market, right? There's someone who's bullish on U.S. stocks in 1999. The same as someone was bearish. So that's why it's important to me to have an objective measure. I don't care what it is. You can use price sales, price book, price cash flow, GDP, enterprise EBITDA. By the way, all of those say U.S. stocks are expensive. There's not one that doesn't. But you have to have an objective metric. Otherwise, you're just what we have found in the literature, and this applies to almost every field, is experts are horrific at forecasting, including our U.S. government, the Federal Reserve, right? They're horrific at forecasting the future. But if you have an objective metric and say, all right, stocks very well could go up 50% from here, but all that's doing is mortgaging the future. So it's unexciting to say, I think stocks are going to do 4% a year. That's not terrible. It's better than a 2.5% bond. But is it worth taking the risk? I would much rather invest in the really cheap stuff, most of which happens to be in Europe right now. So as I said on Twitter, cheer for the U.S. on Sunday, but buy Portuguese stocks.
So how do you avoid the value trap? For example, if Greece had defaulted and exited from the euro, even buying at 2 might have been how expensive?
How do you avoid the value trap? Well, the question is, how do you avoid buying a falling knife and something that's cheap getting cheaper? And there's a couple ways to lessen the impact of it. The first being diversify and buy a basket of 10 countries, right? So, you know, we own Czechoslovakia, a lot of those countries we talked about, Brazil, Russia, one may be doing poorly, and other ones, hopefully, that's same thing as you buy a basket of stocks, helps diversify the risk. Doesn't totally diversify it, because right now, for example, most of those countries are in Europe, in emerging Europe. So you're getting exposure that very well may do poorly. Another way to do it is have a long enough time horizon, you know, give it a number of years to be able to recover. And that's a big key with buying the really cheap stuff. It's hard to watch something go down. The last way is to for those who have followed my research for a long time, know that we write a lot about global macro and trends. And so another way is to use trend following metrics, right? Which would help you say, all right, I'm going to buy this something cheap, but only once it starts to going back up and has a nice trend. And then you still have an objective buy and sell rule. You buy when it's above the long-term trend, you sell when it's below. Historically, that doesn't add to returns, but it vastly reduces the drawdown and volatility. So my favorite intersection would be value and momentum. So buying what's cheap, but also going up. So there's a number of ways to try to minimize the damage it can do, but it doesn't. It's part of buying what's cheap is you're not ever missing all the risk, right?
So say you've decided to invest in certain countries, how do you determine what to buy in that country?
So the simplest would be to buy the market cap weighted index, highly liquid companies. We go a step further, which we actually didn't publish in our book, and buy out of the 30 biggest companies in that country, we buy the 10 cheapest. Use a bunch of just different valuation metrics, so it's almost like a dogs of the Dow approach. So our ETF, for example, will own about 100 stocks in those countries. That adds about another percent return on top of just buying the market cap, because you're getting away from market cap and generally buying the worst of the worst. But as an individual investor, it's really challenging to buy individual foreign stocks in general for a big enough portfolio to diversify, right? 100 stocks in all these countries around the world. And it's a huge pain with taxes too. So one way is to buy country funds like ETFs, Even if you don't buy ours, if you could buy just moving away from the U.S. in general, I think is a great first step. All right, well, good. Thanks for having me. I'll stick around for a few minutes with anybody else.
Thanks, Bob.